Hello, I'm Jerry Romine, the Entrepreneur Abroad. Welcome to my channel. Today, I'm going to teach you how to do a fundamental stock analysis with everything from start to finish. In the last 2 weeks, my channel has blown up, going from around 500 subscribers to over 15,000 because of the financial stock analysis I've been doing. Today, I'm going to teach you how to set up your own financial analysis or how to fully understand mine and use them to your advantage. This video is going to be detailed, slow, and designed to be a reference that you can come back to and use over and over again. In this video's description, I'm going to leave all of the timestamps, so all you have to do is look for the subject you want to cover, click on the timestamp, and it will take you right to that point in the video. Of course, I'm not a financial advisor, and this video is for entertainment purposes only. So grab a cup of coffee and hang on, because this is not your normal stock channel. All right, welcome back. Yahoo Finance is your source for free data, and let's go over the main parts that you want to look at. Number one, the Yahoo Finance page. This is your starting point and has all of your basic data. Number two, the Yahoo Finance income statement. Just as the name implies, this is where you can find all of the income data that you're going to need. Number three, the Yahoo Financial balance sheet. This one has a plethora of information you'll be using. Number four, the Yahoo Finance cash flow page, and lots more data. And number five, the Yahoo Finance statistic page. This one's got a lot of sexy data. All right, now that we've got it worked out where you can get most of your data for free, the question is, should you evaluate one company at a time or several? My personal preference is to normally evaluate multiple companies at the same time in the same sector. That way I can see their individual strengths and weaknesses against their competitors. Now, I personally like to learn through examples, so bear with me if this video is on the long side, because I'm going to take you through an actual financial analysis and teach you all of the steps one by one that I go through. I really believe that this video is going to be very helpful, especially for new viewers to my channel, because this is going to be the go-to video so you understand everything that I go through when I'm doing the analysis at a much faster speed in my normal videos. Once we go through my spreadsheet, you'll see how much time, work, and effort I put into my videos, and all I ask in return is kind of like to keep the channel growing. As long as this channel is growing, I'll keep producing these types of content-rich videos for you. All right, welcome to my spreadsheet. We call it Beast Mode Stock Analysis, and today we're going to teach how to do stock analysis. So I'm going to go slow, so bear with me. We start off with the stock ticker symbol and the company name. We've got MasterCard, ticker MA, Visa, ticker V, American Express, ticker AXP, Discovery, ticker DFS, Capital One Financial, ticker COF, PayPal, ticker PYPL, and Square, ticker SQ. The first part of my spreadsheet is really pretty generic information, and you can get that from Yahoo Finance or a variety of other places. And we've got the current stock price, the industry, price change from the last close, 10-day moving average, the market cap, and this is the total dollar market value of a company's outstanding shares of stock. It's calculated by multiplying the total number of a company's outstanding shares by the current market price of one share. Then I like to look at the 52-week low, the 52-week high, and the percentage of fall from the 52-week high to the low, and then we've got the discount from the 52-week high. Next, we're going to look at the earnings, income, and growth, and we're going to go over all of the data points. Some of the data points are more important than others, but I still want to cover each one individually. We've got the earnings yield, and the earnings yield is the earnings per share for the last 12 months divided by the current market price per share. The earnings yield, which is the inverse of the PE ratio, shows the percentage of how much a company earned per share. Earnings per share is something important that everybody looks at, and earnings per share shows how much money the company is making for the shareholders. The higher the earnings per share, the better a company's profitability. If you do not have earnings per share, then you are speculating that the company will be profitable in the future. So at first glance, whenever we look at this, who's got the highest earnings per share? In this case, it's MasterCard at $7.86, and they have a current stock price of $268.74. But when we combine this and look at the earnings yield, that tells us who's actually making the most on a yield basis or per share. So while MasterCard is making $7.86, if we look at the yield, we can see that Discover Financial is actually paying 17.32%, and that works out to $6.75 per share. The reason why the yield is so much higher is because Discovery Financial has a much lower current stock price. So now when we look at this, we can see that the first 5 companies that we're looking at, MasterCard all the way over to Capital One Financial, all of their earnings per share are in the $5 to $7 range. If we look a little closer at the earnings yield, which I've highlighted in yellow, you can actually see that these three companies, American Express, Discover, and Capital One, are paying a considerably higher yield than MasterCard and Visa. The earnings per share forecast is exactly what it sounds like, and it's just a forecast of the expected earnings. And of course, the bigger, the better. Positive is good, negative is not so good. The revenue growth forecast is the forecasted revenue, and it's interesting to see that MasterCard and Visa, as well as American Express, are declining. Meanwhile, Discover, Capital One, PayPal, and Square are increasing. And I would expect PayPal and Square to be increasing by even more with everything as we move into the digital age. The PE ratio is one of my favorite things for a quick check, and ideally I like that number to be under 20, and that's because historically the average on the S&P 500 has been from 13 to 15. And one way of looking at the PE is based on the earnings, it would take you the PE number in years to purchase the business on the current valuation. A low PE is a fast recouping of your investment. So if you look at it that way, it would take you basically 34 years based on the earnings for the current valuation at $268. By comparison, it would only take you 6 years for Discover, and it would take you 57 years for PayPal and 73 for Square. So now you can see why, as a value investor, the lower the number, the better. And since PayPal and Square have a high PE ratio, I'm going to go ahead and check the box, and that turns them red, and that's my cue that I'm not interested in these guys from a valuation standpoint. And one more thing I mentioned, I built my spreadsheet as a cheat sheet, so anytime you see an up arrow, that means that we're looking for a higher number, and if you see a down arrow, that means we're looking for a low number. So let's go on to gross profit. And gross profit describes a company's top line earnings. It's revenue less the direct cost of goods sold. The gross profit margin then takes that figure and divides it by revenue to get a handle on how much gross profit is generated on a percentage basis after taking costs into account. So for the gross profit growth on these companies, we've got MasterCard at 11.43, we've got Visa at 10.35, American Express negative 1%, Discover negative 6.8, Capital One Financial negative 16, PayPal coming in at 11%, and Square coming in at a nice 44.69%. The net profit growth is exactly what it sounds like, and it's just the net profit growth from one year over the next. And when we look at the numbers, we can see that MasterCard is coming in at 27.61%, Visa at 12.17%, and then American Express, Discover, and Capital One all not doing so well on net profit growth. We've got PayPal that is growing, and we've got nothing showing for Square. Our next stop is the net income margin, and you'll notice I have this highlighted in blue, and that's because this is a really important one for me. So net income margin is calculated by dividing the net profit by total revenue, and it represents how much of each dollar of revenue earned results in net profit for the business. Net margin is a very good indicator as to how efficiently managers operate a company. So this is a big one for me, and now we're getting into the good stuff. MasterCard, 48%. We've got Visa at 52.6%, and then we've got Discover at 22.38%. All of those are jumping off the page and standing out to me. The BM score is one indicator of many that I look at, and this is a statistical score that uses financial ratios to identify whether a company has manipulated its earnings. Think about Enron, and that's what we're trying to avoid. And the bigger the negative number, the better. So a BM score greater than negative 1.78 indicates a strong likelihood of a firm being a manipulator. A score smaller than negative 1.78, it's more negative, is good. So in this case, the more negative the number, the better. And I hate negatives when I'm looking at these because it's so easy to get confused. But I've got everything color-coded, so if it's in red, that's a warning sign for me. And the bigger the negative, the better. So in this case, our best one here would be Capital Financial at negative 3.81. And this is just one indicator of many. I mention it here because it's something that I look at, and if I see something red, that's just a warning sign, and it means that I might want to look a little deeper into it. The net income forecast is the compounded annual growth rate, and this is pretty interesting to look at. So for MasterCard, we've got 10%, Visa, we've got 8%, American Express, 1.42%, Discover is down in the negatives, Capital One is down, and now we get over into IT services, the technical digital companies, PayPal and Square, and look at their numbers. PayPal has a net income forecast of 18.3% and Square at 51.62%. This is indicative of growth companies, and this is where we can start to see some power changes. MasterCard and Visa, they've been around for a while, they're growing, but your high growth companies, they have a high PE and they're also growing faster. The return on equity is another one that I like to look at because it's a real benchmark and it's used throughout the industry. And the ROE measures how effectively management is using a company's assets to create profits. And a shortcut, an ROE near the long-term average of the S&P 500 of 14% is an acceptable ratio, and anything less than 10% is poor. So here we've got MasterCard at 27%, Visa at 24%, both coming in strong, American Express and Discover and Capital One Financial coming in at weak, and then in this case PayPal is up and coming, and their PE ratio is also going down. Given a little bit more time, PayPal's PE ratio will come down, and it could be a very attractive investment for me. But for right now, it's not one that I like. And just because I don't like it from a fundamental standpoint doesn't mean that it's not a great company for somebody else to invest in, or it could also be a very good company to invest in from a technical standpoint. Today's video, I'm just focusing on the fundamental side of things. All right, the free cash flow yield is the amount of cash a business has after it pays for capital expenditures. A higher free cash flow yield means a company has enough cash flow to satisfy all of its obligations. Low yields means investors aren't receiving a very good return on the money they're investing in the company. So for the free cash flow yield, we want that number to be ideally above 5, and we can see where the numbers are coming in, and of course, they vary from company to company. The shareholder yield is the 3 ways management of a public company can distribute cash to shareholders, with cash dividends, stock repurchases, and debt reduction. The higher the number we've got here, the better. So in this one, our best looking ones would be American Express and Discover. Our next section is dividends, and I consider dividends to be a bonus when investing into a good company, and it can be a really nice bonus too. So the dividend per share and dividend mean forecast, those are pretty straightforward, but the dividend yield is something I like to look at, and that's how much a company pays out in dividends relative to the stock price. I like 4% or higher, and dividends often show stability. Ideally, modest, regular, and increasing dividends is a good sign. Crazy high dividends look great on paper, but companies need to reinvest in themselves for continued growth. So here, you can see where the numbers come in yourself, and we can see that Discover and Capital One are paying a dividend yield of 4.25 and 7.79%. Not too bad. Looks good. The dividend payout ratio is a fun one to look at because it shows how much money a company is returning to shareholders versus how much it is keeping on hand to reinvest in growth, pay off debt, or add to cash reserves, retained earnings. A high percentage is good, but too high, for example, greater than 100%, can be bad because a company needs to reinvest back into the company and not just pay shareholders. So here we can see a lot of these dividend payout ratios at 17% on up to a high of 36%, and PayPal and Square aren't paying them yet. They most likely will over time. The dividend growth rate is the annualized percentage rate of growth that a particular stock's dividends undergoes over a period of time, and the higher the number, the better. And then I always like to look at the dividend frequency, and we can see that most of these companies that are paying dividends, they pay them quarterly or 4 times a year, but Capital One, they actually pay theirs monthly. Our next section is the financials, and we want to see if the company is running on good margins. And all of these numbers here are in millions. So MasterCard has 17 billion. Visa has 23.8 billion. And let's go through each of them. Total revenue is the full amount of total sales of goods and services. It is calculated by multiplying the total amount of goods and services sold by the price of the goods and services. The cost of goods is the total cost of manufacturing and delivering a product or service to consumers. Operating income or operating loss measures the amount of profit realized from a business's operations after deducting operating expenses such as wages, depreciation, and cost of goods sold. Gross profit is the profit a company makes after deducting the costs associated with making and selling its products or the costs associated with providing its services. Gross profit will appear on a company's income statement and can be calculated by subtracting the cost of goods sold from the revenue. The cost of goods margin is one that I like to look at, and this is the total cost of manufacturing and delivering a product or service to consumers, and the lower the number, the better. The gross margin, the higher the number, the better. The gross margin is calculated by dividing gross profit divided by the total revenue and expressed as a percentage. The less a company spends towards its cost of goods sold, the smaller the difference between gross profit and total revenue, and the greater the gross margin. So we want the highest number possible here. And Visa's coming in really nice at 96.9. Gross margin for MasterCard is 100, everybody's looking pretty strong here. The operating margin is one that I really like to look at, and this measures how much profit a company makes on a dollar of sales after paying for variable costs of production, such as wages and raw materials, but before paying interest or tax. It is calculated by dividing a company's operating profit by its net sales, and we want the highest number possible. So what's jumping off the page on this one is MasterCard and Visa are both coming in strong at 57.3% and 66.9%. Discover Financial also gets an honorable mention, coming in pretty good at 39.6%. The Altman Z-score is a fun one to get a quick check on, and it determines whether a company is headed for bankruptcy. The formula takes into account profitability, leverage, liquidity, solvency, and activity ratios. An Altman Z-score close to 1.8 suggests a company might be headed for bankruptcy, while a score closer to 3 suggests a company is in solid financial positioning. So when we look at this, everybody is coming in strong here except for Capital One Financial. They've got an Altman Z of negative 0.46, and that is a concern. Next, we want to look at the balance sheet to see if a company is financially stable. Our first stop is total cash and short-term investments, and these are cash deposits at financial institutions that can immediately be withdrawn at any time, and investments maturing in 1 year or less that are highly liquid and therefore regarded as cash equivalents and reported with or near cash line items. Total current assets, these are items that can be liquidated into capital within 12 months, and total current liabilities are liabilities that are due within 12 months. And that's going to get us to the total 1 year current access. And this tells us if a company could survive if it had zero revenue for the next year. So to get the total 1 year current excess, all we do is subtract the current liabilities from the current assets. One way we can conceptualize the 1 year current excess would be if we looked at it as if it was an emergency fund for our personal life. Let's say that you make $4,000 every month. For you to have a 1 year current excess, that would be 4,000 times 12, or 48,000. So if you had $48,001, you would be in the black and you would have a 1 showing right here. Now let's say that you didn't have 1 year saved up for your emergency fund. Let's say you're making $4,000 a month and you're spending $4,000 a month. If that's the case, you would be in the red. So it's not critical that you have 1 year saved up, but I think you'd agree you're in a stronger position if you have a 1 year current excess of cash, and that's all this is showing us right here. Now the current assets versus current liabilities is a ratio, and we want that number ideally to be over 1, and this just shows the company's total current 1 year excess relative to the company's assets and liabilities. All right, next we've got the total assets and total liabilities, and these are the overall totals for the company, and then that brings us to the total assets versus total liabilities, and I call this the tattle ratio because it tattles on the overall strength of the company. Ideally, I like to have a number that's over 2, and that just means if it was a 2, they would have twice as many assets as liabilities. So when we look at the companies here, we've got MasterCard at 1.2, Visa at 1.9, and these guys are coming in the strongest, and you can see where the rest of them come in across the board. And I have this highlighted in green because it is a very important one for me to look at. The total stockholders' equity represents the amount that would be returned to shareholders if all of a company's assets were liquidated and its debts were repaid. The debt-to-equity ratio compares a company's total liabilities to its shareholder equity and can be used to evaluate how much leverage a company is using. Higher leverage ratios tend to indicate a company or stock with higher risk to shareholders. The result is the dollars of debt for every dollar of equity, and we want to compare this ratio to other similar companies. Here, the lower the number, the better, and we can see that Visa is coming in with a very nice low number. MasterCard is considerably higher, and this is a direct comparison for competitors. We can see American Express at 7.86. Discover at 11.32. That's considerably higher, especially compared to Visa. And then we've got Capital One Financial, and look at this. PayPal and Square, they're actually coming in as fairly low risk because they do not have a higher debt-to-equity ratio. All right, now we come down to our blue arrows that are pointing up. And at this point, we're done with the financial analysis, and we want to start looking at which companies are the strongest based on all of the above information. And what I've done is I've color-coded my spreadsheet to what's the most important for me. We'll start with the blue. I like a net income margin and a total shareholder yield. These are two things that I heavily value. After that, I start looking at the green ones. So it goes blue, then green, and then tan. And those are the different fields that I'm weighting the most. Everything in white I like to see and consider, but again, it's the blue, greens, and tans that I put the most emphasis on. So now that you know how I color code things for a priority, let's go through this with a little bit more detail. We'll start at the top and we'll scroll down, and lo and behold, our first big one is net income margin. And that's because I like to have a company that's making money. As a long-term investor, I think that it makes sense to find companies that are making money. Then I look at the total shareholder yield, and the shareholder yield are the three ways management of a public company can distribute cash to shareholders: cash dividends, stock repurchases, and debt reduction. So this is how they can increase shareholder value. So first, is the company profitable and making good money? Yes. Check. I like that. Then the total shareholder yield, because now they're increasing my value as a shareholder on an ongoing basis. Next, I look at the greens, with the exception that I don't put any weight on the 10-day moving average. I just like to see that up above. As for the rest of the greens, it's telling us what they've got for earnings, what they've got for income ratios, and that's really important to me. And then one of my favorite parts on the greens is down here, and that's the tattle ratio, because that speaks to the overall strength of the company. If they've got a lot more assets than liabilities, I view that as a good thing. And now's a good time in the spreadsheet analysis for you to make a decision on which companies you like the best. And even though we're looking at the same data, that doesn't mean we'll arrive at the same conclusion, and that's okay. Everybody has different criteria for what they're looking for. All right, now we are in beast mode stock analysis phase 2, and this is where you look at the valuations, price targets, and analyst sentiment, and everything here is subjective. We're looking now at the price to earnings valuations, and we've got some different PE ratios here. We've got a forward PE, a 5-year adjusted PE, and we've got the current PE ratio that we already have from above that we're bringing down, and then we've got the PE discount from the 5-year average. And this is just a quick check to see whether or not we're buying at a discount to the 5-year average. Next, we've got the Peter Lynch Fair Value Estimator, and this is a quick check indicator, and my formula is modified from Peter Lynch's original formula. And I want to make sure you understand that this is definitely not an end-all be-all indicator. In fact, it doesn't work very well on growth stocks, but it does work well on some types of stocks, and that's why I have it here. And if it does give me something that is near value or under value, it's just a good sign for me and something I like to do a quick check on. All right, the Fair Value Intrinsic Estimator is a conservative estimate for the future value of a stock. And let's go through this for each of the different companies. We've got MasterCard currently trading at $268.74, and we've got an estimated intrinsic value of $288.67. Visa, $175, estimated $166. American Express, $88, estimated $89. Discover Financial, $41, estimated $48. Capital One Financial, $61, estimated $47. We've got PayPal, $120, estimated $105, and Square at $63 with an estimated of $51.58. Next, we've got the Fair Value Intrinsic Upside Estimate, and that number is either going to be positive or negative depending on where the numbers come in. And then we've got an uncertainty level. This is just the uncertainty that we have in these numbers. For example, we've got a very high uncertainty level for Capital One Financial. Whenever possible, I like to buy below that intrinsic value. However, it doesn't always work out that way, and again, this is just one indicator and one data points of many that we want to consider. A lot of people have asked me how my Fair Value Intrinsic Estimator works, and I actually average a lot of different intrinsic values, and my number generally should be coming in on the conservative side. But if you're interested in figuring out your own, let me take you over to a site, and this is at TradeBrains, and it's TradeBrains.in, and it's their Fair Value Calculator. You can Google it, and they actually have a Fair Value Calculator that you can use where you put in the information and they walk you right through it, and that can help you to determine the fair value on your own. Our next stop on this journey is the analyst recommendations, and we've got buy, hold, and sell recommendations, and I always like to see where the analysts are. It doesn't mean that I agree with them, but it's still a fun thing to check out. And if you want to check out your own analyst recommendations, head on over to Yahoo Finance, put in the ticker symbol, and here I've already put it in as MasterCard, ticker MA, and then scroll down on the summary page, or most of the different pages, and you'll see that there's a lot of information. And if you get to this section here, we've got the recommended ratings, and you can see strong buy, hold, underperform, sell, and then they also have analyst price targets, and they're coming in at 313.18. And then we can look at the days to cover short, and the official name for this is the short ratio, and it's based on the stock's average daily volume, how many days it will take short sellers to cover their positions if positive news about a company lifts the price. Typically, if the days to cover stretch past 8 or more days, covering a short position could prove very difficult. And here we can see that the days to cover short are all under 3.6, so everything's looking in pretty good shape here. But if you see something that's 8 or higher, it's just simply a red flag that there's a lot of short sellers out there and it could be a bearish indicator. My next stop is to look at the analyst price targets, and we've got a low, an analyst target mean price, and that just means average, a high price, and the upside percentage. And I like to look the most at the mean price because I want to keep my estimates conservative. So here we can see MasterCard is currently trading at $268, and it's got an analyst target price of $310. We've got Visa at $175, $199 on an analyst mean price. American Express at $88.32, an analyst price of $102. Discover Financial at $41 with an analyst mean price of $50. Capital One Financial at $61 with a mean price of $77. PayPal at $120 with a mean price of $125. And Square at $63 with a mean price of $61.74. All right, book value per share is something that I like to look at, and it's rare to be able to buy below book value. For you Warren Buffett value investors, this is always a fun one to look at. So what exactly is book value? It is a key measure that investors use to gauge a stock's valuation. The book value of a company is the total value of the company's assets minus the company's outstanding liabilities. When a stock is undervalued, it will have a higher book value per share in relation to its current stock price in the market. If negative, it's more debt than assets, and bankruptcy is a possibility. So when we look at the book values here, we can see that MasterCard has a book value of 5.38 and a current stock price of $268.74, and then we use a book value ratio, so it's an apples to apples comparison. If it's a 1, they're trading at par. If the BV ratio is above 1, it means that we can actually buy below the book value. And we're lucky because today we actually have Capital One Finance, and they have a book value per share of $113.38, and they have a current stock price of $61.58. And we can see that the BV ratio is 1.84, meaning we can actually buy this at a discount to its book value. We don't see that very often. Pretty cool that we can actually see it here. All right, the PEG ratio is a common indicator used, and it determines a stock's value while also factoring in the company's expected earnings growth, and is thought to provide a more complete picture than the more standard PE ratio. A PEG ratio can be negative if a stock's present income figure is negative earnings, or if future earnings are expected to drop, which would be negative growth. So here we're just looking at the PEG ratios. Anytime we've got negative, it's a caution sign, and if it's less than 1 on a PEG ratio valuation, that means it's undervalued. And finally, the last one we're looking at is the Piotrowski score, and this helps find companies with a healthy liquid balance sheet, profitability, and operating efficiency. Ideally, we want that number to come in at 5 or above, and everybody is coming in at that number with the exception of Capital One. Whew. You can see an awful lot goes into my videos, and if you'd like to see more, then all I ask is for a like and a subscribe to keep the channel growing. I really hope that this video has been helpful, and if you have any questions, remember I've designed it where you can go back into the description and every point is time-stamped where all you have to do is click on it to go to the exact part of the video that you want. One question that I get a lot is if I'll share my spreadsheet, and the reason I don't is because it has so much custom programming that has to be updated frequently. All right, let's get on with today's pick. All of today's companies are making money, so that's a really good start, and understand that your picks might be different than mine. PayPal and Square have really high PE ratios, so I'm not personally interested in those, especially when you compare them to Visa and MasterCard, which has a much higher net income. So from this group of stocks, my favorites are MasterCard and Visa. I want to stress that I am not a financial expert, and I'm just sharing with you my research. You might have a different opinion or reach a different conclusion, and that's perfectly okay. Always be sure to do your own research and draw your own conclusion. I hope that you enjoyed today's information. Please sound off in the comments below and let me know what you thought of this video. If you haven't already, make sure you sign up for Webull and claim your 2 free stocks worth up to $1,400. I use Webull. It's free with some great charts and tools. Your 2 free stock promo link is in the description. Thanks for hanging out with me today. Send and love your way, and I'll see you tomorrow with a fresh new video.